Wolfspeed is another unfortunate byproduct of the slow-growing electric vehicle industry. As a key supplier of silicon carbide chips, which are critical for EV powertrains and charging infrastructure, Wolfspeed was counting on the growth in the EV industry to increase sales for its products. Unfortunately, it's gone in the opposite direction, and the company's trailing 12-month revenue is significantly below where it was in years before. It's undergoing a transition and it's trying to recover from this, but that remains to be seen. Investors are asking if this is a buying opportunity or should they avoid Wolfspeed stock. I'll answer that question of whether or not this is a buy, hold, or a sell, looking at the company's historical performance and looking ahead on what investors can expect from its prospects. I'll share with you my discounted cash flow valuation model for Wolfspeed and look at the valuation on a forward price to sales basis to come to the conclusion if the stock is buy, hold, or sell. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So looking at Wolfspeed's trailing 12-month revenue, you can see the impacts of slowing growth at 776 million. It's way below the 1.6, 1.7 billion it was generating in 2015. It started a recovery in 2020 and revenues are significantly above where they were in 2020, although nowhere near where the company had hoped. Challenges remain in the electric vehicle industry. Consumer demand is relatively weak. And the reason I say that is because with all of the investments that have gone into the electric vehicle industry, trillions of dollars from governments, hundreds of billions of dollars from businesses ranging from manufacturers of cars to manufacturers of the charging stations to everything that's going around the industry. There's been trillions of dollars put into it. And the consumer response has been not that strong everywhere outside of China. The growth rates are, like very, very 10%, 12%, small rates of increase, which do not match the significant sums of money that have been poured into this industry. Still, there are hopes that eventually the technology, the charging infrastructure, the charging technology will improve enough where it makes sense for consumers to adopt this technology. As it stands right now, it doesn't make sense for consumers to choose these electric vehicles. That might change, but there are no signs of that for any time in the near future. And with the recession fears rising, interest rates thankfully have fallen, but with recession fears rising, that's led to fuel prices falling. And when fuel prices are falling, it makes even less sense to switch to electric vehicles. So Wolfspeed, unfortunately, is exposed to an industry that's not very attractive. It's one of my least favorite industries. I don't know what's worse, electric vehicles, airlines I also dislike, car manufacturers overall. Those are just unattractive industries to be involved with. And at least Wolfspeed is offering the chips that go inside these, and they're not an actual electric vehicle producer, which would be much worse in my opinion. The cash flow from operations has gone in the wrong direction for Wolfspeed, falling to $703 million negative for the trailing 12 months. And the analysts on Wall Street that are following Wolfspeed stock, as I'll share with you a little bit later when I look at valuation, they are forecasting the company will continue generating negative free cash flow for the next couple of years. Only after a few years do they expect this turnaround to be complete. The returns on investor capital, similar to the cash flow from investors, similar to the cash flow from operations, going down and heading in the wrong direction. The number is negative, the trend is negative, both what you do not want to see when you're considering a stock for investment at negative 15.44%. doesn't look good for Wolfspeed. The balance sheet is also not in very good shape. Its total long-term debt at 4.46 billion is about 3 times the size of its cash and short-term investment balance at 1.4 billion, and the company is losing cash quickly at about $60 million per month. At that pace, it's got a couple of years of runway before it runs out of its cash and short-term investment balance. So thankfully, the analysts on Wall Street do expect the company to turn things around in a couple of years here and start generating cash flow positive again, because it cannot sustain these negatives for very much longer, and it already has over $4.4 billion in debt. It's going to find it difficult to raise more debt while it's losing money, and it already has this much debt. They're going to get asked to pay very prohibitive interest rates if they want to go to the market and borrow money under their current circumstances. So unsurprisingly, the stock price has not performed well in 2025. It's down 19% year to date. I would have expected the stock price to be down more than that, given the company's performance, given the industry it's operating in, and the poor prospects for electric vehicle demand in 2025 and probably in 2026 as well. Starting to look at valuation, Wolfspeed stock is near the cheapest it's been according to the forward price to sales ratio at 0.806. And I think that's appropriate. I think it should be trading at very cheap valuations because of its poor prospects and poor performance and exposure to an unattractive industry. When I did the discounted cash flow valuation model, as I talked about, the analysts on Wall Street expect things to turn around relatively quickly. So the company was negative in $3 billion in free cash flow in 2024. The analysts expect another negative 1.6 billion in 2025, another negative 400 million in 2026, another negative 60 million in 2027, before things start to turn around at 150 million positive in 2028 and 130 million positive in 2029. So thankfully, the analysts do expect a turnaround. In other words, my intrinsic value per share that I calculated for Wolfspeed stock, taking account for the turnaround and giving the company credit for turning things around and starting to generate free cash flow, strong free cash flow over the next decade, starting in 2030. My intrinsic value per share has it at $5.99, which compares relatively well to the current market price of $5.39. So overall, what do I think about the company? Is it a buy, hold, or a sell? I just updated my rating today. I've given Wolfspeed a hold rating on March 10th, 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.